Good morning, everyone. This is episode 31 of Meet Me for Coffee. I'm actually on a family vacation in Florida, but that's one of the beauties of working from home and running a podcast from home is it just goes with me. So really excited to be stepping back into the podcasting space for a little bit this morning. It is 60 something and sunny in Florida, so I can't complain. And I have Chris Pickett as my guest today, so I also have nothing to complain about because I'm really looking forward to this coffee conversation. I'm going to go ahead and bring Chris in. Chris is the founder of Pickett Research and the COO at Flock Freight currently. Good morning, Chris. How are you?
I'm fantastic. Thanks for having me back.
Absolutely. Yes. So some people might remember Chris from our special edition episode right in the first week of January, I think it was. He was on a panel with some other amazing gentlemen. And basically, when you have four people and an hour, one person doesn't get enough time to talk. And so I had to have Chris back so we could have a full conversation. So Chris, would you mind just introducing yourself, giving a little bit more background on who you are, what you do?
Yeah, you bet. I guess I'll give you the quick, long story. So Samantha said, Chief Operating Officer at Flock Freight, founder and lead market analyst at Pickett Research. Been in the logistics industry for roughly 25 plus years. Even all the way back to the beginning. Started, grew up in Northern Virginia, outside of Washington D.C. Studied industrial engineering at Virginia Tech. Go Hokies. Graduated in the late 90s. With really not knowing what I wanted to do, just something kind of at the intersection of technology and supply chain management and logistics. So ended up taking a job with Anderson Consulting, which is now Accenture, large technology consulting firm that was on campus, hiring engineers and a bunch of other roles, and ended up getting a job in their San Francisco office. Didn't spend much time on the West Coast. I don't think it really had been west of the Mississippi at that point. Found myself in San Francisco in 1998 with an engineering degree working for a technology consulting firm. Turned out that wasn't a bad place to find yourself, where the kind of the front end of the first .com revolution eventually became a .com bubble that eventually burst. But working for a tech firm, ran into all kinds of interesting people. Every other guy or gal you met at the bar on the weekends just raised $6 million to sell pet food online. So a lot of just fun stuff was happening at that intersection of e-commerce, sure, but very much logistics and technology. So about a year and a half, joined a startup, which I kind of had to at that point. SoftBank funded, building e-commerce distribution software. So think about kind of fulfilled by Amazon before there was fulfilled by Amazon. We just happened to be 20 odd years ahead of our time. But we had some success. We got big-ish and then got small again. .com bubble burst. Weren't going to make it public. Sold that business to another tech firm in the logistics space. I got the startup bug. Ended up going back to grad school. So at that point, it was like, holy cow, early stages is cool, but no one's going to give me all of 24 years old another $87 million to go start a business. So did the next best thing. Went to grad school, first at MIT, did a master's degree in logistics, where I found myself in a cohort with a guy named Jeff Silver, and also a guy named Bill Driegert, who I would reconnect with later. Did a grad degree in business administration at Georgia Tech after that. After that program was over, ran into Jeff again. Early stages, kind of very, very almost pre-Coyote. Talked about an idea. He was kind of thinking about how to apply technology in novel ways to the U.S. brokerage industry. That became what became Coyote Logistics. So Jeff recruited me. I was living in Atlanta at the time, moved to Chicago in 2006, and was part of that early leadership team that eventually went on to scale Coyote into a $4 billion plus business with an acquisition by UPS along the way. Left Coyote at the end of 2020. Ended up standing up Pickett Research. Part of what we'll talk about is just the application of these cycle frameworks to anticipate the direction of spot and contract freight rates. So stood that up and then joined the leadership team at Flock Freight early summer 2021. And so here I am today. So again, full-time jobs with Flock, still publishing under the Pickett Research kind of umbrella, and then still doing some advisory work with firms like Everest Transportation Systems, Good Ship, and a company called Channel 19.
This is why I call this show Meet Me for Coffee, because I'm like, I have my coffee and you introduce yourself and instantly I'm like, so many questions. Like, just have to sit here and ask so many questions off of that. One of the first ones I think that comes to my mind when you talk about the early stages of Coyote Logistics, and you said specifically you and Jeff were kind of just thinking about the landscape of brokerage. What was the landscape of brokerage then? Like, what did the brokerage market look like in the freight space when you guys were in the early stages of founding Coyote. And then also I asked that because you shortly into that journey started what eventually I think kind of became Pickett Research, right? But that was a model that you were deploying within Coyote. So where was the landscape at, and why was there such a need to better understand the type of market analytics that you do and how that goes into pricing and how that fit the brokerage landscape? Why? I'm assuming because you had to build it, there wasn't already something created that could do that for you guys. So I just want to like go back and understand how you identified that need.
And believe me, Jeff had this pretty well mapped out. Yeah, I think before I was part of the conversation. So it's not like Jeff and I were kind of held in the corner trying to map out freight. He's been a tight in this industry for a long time. So he had absolutely some conviction and perspective on what the market was lacking, and what the market was lacking at that point. And this is 2006. Was another large-scale non-asset-based platform to really compete head-to-head against C.H. Robinson. C.H. was the big gorilla on the block, and it still is, really by almost any measure. You really have too many billion-dollar plus non-asset-based platforms to compete. And the very simple idea that Jeff had and we developed was, can you go to market and build a large-scale platform with all the capabilities and strengths that you'd expect out of a multi-billion-dollar, tech-driven, freight giant, but also operate with a level of service and commitment, and really honesty and transparency that you wouldn't expect, from a billion-dollar market leader. And it was kind of, how do you do those two things at the same time? And our observation at that point in time was, to get big, you had to be very active in the contract sector. You can really build a multi-billion-dollar platform just playing in the spot market and riding the cycles right up and down. You had to take a stand, and you had to carve out these big positions, in our mind, with large enterprise contract shippers, like a Coca-Cola's of the world and the Anheuser-Busch's and the Home Depots and all the usual suspects. And we were very successful in doing that, very early on. And that was a huge kind of component of the runaway kind of hockey stick growth that kind of characterizes the Coyote journey. But if you're going to do that, you're also taking on an awful lot of risk. By definition, most non-asset-based platforms, if you're going to sell contract, you're going to commit to a contract rate. Almost always you're going to be buying that capacity out in the spot market when it comes time to deliver that capacity to fulfill that obligation. And so you're selling contract, you're buying spot. And if you get that wrong, right, if you materially misforecast your cost basis, either you're going to predict too high and you're probably not going to be competitive, you're not going to win that business, or you're going to predict too low and your costs end up being much greater than what you'd anticipated, and that creates all kinds of challenges. At the very least, it's financial challenges, but depending on how acute that gets, also service and relationship challenges. And so also the origins of kind of what was the Pickett curve that became the Coyote curve that still kind of underpins kind of how I think about the markets, was this idea if you could just get directionally on the right side of the market, predict our rates, spot rates likely to be up or down. And if you do that consistently, then you're going to be ahead of 99% of the market. And so ultimately that was the mission of, can we predict confidently, at least the direction of spot rates, such that we can make better long-term commitments to our contract customers.
How long-term are we talking here? Like how long-term do you think we can make at least better predictions?
It started with just a year ahead. I mean, this trucking market is incredibly dynamic, incredibly complex. I'm not going to pretend to tell you I know what rates are going to do today or tomorrow or even next month, or even next quarter. But next year, again, just based on these kind of historical patterns that, I assert are much more consistent than what folks appreciate, certainly a year in advance. And if you kind of, take that idea that, the U.S. trucking market operates in a recurring cycle, and really that's the entire assertion. Like to sit here and tell the audience, hey, the U.S. Trucking market runs the cycle, that's not a controversial statement.
Sure.
I think what always frustrated me when I came into the industry in 2006 with kind of an engineering mindset was, I would be told, hey, just certain times the shippers have the upper hand and they're going to push prices down. And there are certain times when the carriers have the upper hand, they're going to push prices up. Market runs in a cycle. If that's true, and if you can tell me no one can ever tell me where we are in the cycle. Okay, that's fantastic. Great idea. But hey, where are we? Because if I know where we are and this market operates in the cycle, then you should have a pretty good idea of where the cycle is headed. And so when you start to develop the kind of the methodology that goes into these cycle characteristics, see that, on average, cycles last 3 to 4 years. I've observed 5 since I've been keeping track, since 2007. And they're all pretty consistent, in terms of duration, in terms of how long it takes to get from equilibrium to peak to trough, back to equilibrium. And it's fundamentally driven by the psychology of the market and the fundamental structure of this industry, specifically how just inherently fragmented it is.
Yeah.
And, once you acknowledge that there is a cycle, then you start to get to work on, well, if that's true, what drives the cycle? If it's supply and demand, kind of what are the things you can look at that help you build either confidence or uncertainty around the mechanics of the cycle that will eventually kind of tell you just how confident you are in your outer predictions. But if we are in a cycle and the structure of the cycle is the same, there's no reason you couldn't predict, 5 to 10 to 15 years out.
Yeah, I'm with you there, at least on understanding the cycles, right? Maybe not exactly like nobody could have predicted what would have happened with the pandemic, but we at least knew that it still matched some sort of cyclicality to years past. So, okay, we're going to have to come back to more market talk too, but before we get too far into that, that was the Coyote days. That was the start of Coyote Curve, which is formed into your Pickett Research work now. How does all of this background and this understanding lend to scaling a startup or you guys are in the brokerage space now as well at Flock. So why, from everything you've learned over these decades of experience, how have you seen that really come into play and transform when you are working on scaling a new business in the current transportation industry?
So I think the fundamental, hypothesis or thesis at Flock is that, on their own, traditional LTL transportation, traditional full truckload transportation are insufficient to support kind of the modern supply chain. So if you've got an order that doesn't require a full truck, you've got three bad options. You can either just send it full truckload, pay to ship air, and certainly that happens a lot. 30% of U.S. trucking capacity is exactly that. It's air. It's wasted. You can hold that order and say, okay, I'm going to wait till another half order kind of accumulates, and then I can get a full truckload and get the unit economics I'm looking for from a transportation standpoint. But then you're just adding inventory carrying cost and and order lead times. Or depending on the size, you can ship it through the traditional LTL hub and spoke, where depending on the length of haul, it's going to hopscotch its way through a terminal consolidation network. Takes time. Transit times can be variable, gets touched a lot. So you see a lot of damage and loss in transit.
Sure.
Our theory is, hey, if there was a way to get full truckload service, just pay for the portion of the truck that you need, same truck, same driver, no terminal consolidation, wouldn't that be a viable option to consider? Right. So ultimately that's what Flock is scaling and selling is, can you build consolidations in a route where we're going to take someone's half truckload, marry it with someone else's half truckload, build a 2-pick, 2-drop, go out and book it as a multi-stop truckload to a carrier. And if you can do that at scale, you would kind of unlock this supply side arbitrage where you can provide a way for both shippers to save money. We can actually pay a carrier more and still yield a market leading gross margin profile to reinvest in the business. And so when you think about what the alternatives are for shared truckload, on the one hand, if your alternative is LTL, and we need to understand what's happening in the LTL markets to understand whether this represents a good deal or not. If your alternative is underutilized truckload, then we need to also understand what's happening in the truckload market. And so just predicting the direction of truckload pricing as well as LTL pricing, just helps us think a lot more clear around the things we choose to build, how we think about growth strategy, where we think relative opportunities are going to be, and how do we continue to invest in the platform such that we are creating truly differentiated value for both the demand side as well as the supply side.
Yeah, I love that last sentence you just said there, creating value for the demand side as well as the supply side, because in my mind, as soon as you started talking through that model, I was thinking how it probably helps your carrier partners insulate themselves to some extent from the volatility in the marketplace. If they're, like you said, you can put 2 loads on one truck, you can make a little bit more that can pass through to the carriers. So you guys can probably buy your capacity or keep that capacity engaged a little bit better than when we're seeing really low markets like we are right now, and brokers, like you mentioned earlier, who are locked into maybe cheap contract freight are trying to sell even cheaper in the spot market. So I could see how your model would be really meaningful to carriers who choose to engage and partner with you guys.
The whole point is to just create another way for asset-based fleets to drive higher revenue yields. And so even just the basic math of kind of those 2 half truck scenarios, you'd rather shipper A don't pay a full truckload rate, pay 70, we'll give you say 75% of your truckload rate. So you're going to save 25%. Shipper B, same thing. So now I have 2 shippers saving 25%. We have 150% of the revenue on the shipment. We then go turn around and pay a driver or carrier, say 120%. So 20% more of what they would normally make, because there is an extra stop, no doubt. but you can show a higher revenue yield per mile, sure, but also per unit of time, and also yield, in some cases, a 25 to 30% gross margin at full utilization to get to reinvest in the business. So it's quite literally this model where shippers are paying less, carriers are making more, platforms are reinvesting, and by the way, we're also saving 20 to 40% of excess carbon emissions by actually filling up the trucks that are out in the marketplace.
Yeah. And I would like to say too, there was a time in my career when I was selling full truckload brokerage and I didn't know what higher revenue yield per mile or higher utilization meant for an asset carrier. So I think there's also a big opportunity just to anyone listening or to this market in general for brokers to better understand the positions of carriers and how they're running their fleets. And I know that that's in part an emphasis of the study and the work that you do to understand the market and understand what's going on and how that impacts carriers, which ultimately impacts brokers. And I think, unfortunately, we just don't educate ourselves enough on the brokerage side as what your carrier partners are dealing with and how they look at their businesses, how they have to operate.
Absolutely. I mean, that's, I think, one of the lessons of the cycle is just kind of how violent this volatility looks on the chart sometimes, and honestly, how violent it is. Well, honestly, what's driving this is surplus supply comes in when the market's attractive, and the market can't recover until that surplus supply exits. So again, if there are tools, if there are tactics, if there are kind of ways to engage with the asset-based side of the marketplace to try to tame some of that volatility, I mean, that's got to be a win-win for both sides.
Absolutely. Okay, so I would love to ask you some more questions about the market now, as we've kind of been talking about it and mentioning market cycles and what's going on in the marketplace. So I think we talked about this on the special episode that you were on with some other guests. We had Ken and Jason on as well, Rob from Coca-Cola. And so we talked about how market cycles have been consistent. We just mentioned that on this, but a lot of people were shocked at kind of the prolonged length of the most recent market cycle that we're in, kind of how sustained the highs were and how sustained the lows have stayed now and seem to be continuing to stay. Mm-hmm. And I would love to just get your thoughts from a high level on what's going on right now with the current market cycles. And then as we're all trying to understand now what is happening in 2024 or 2025, because there was a lot of conversation around Q2 2024. And some people are still on that stance. Some people are starting to push back to the beginning of 25. But can we just talk about what you think is going on? And then what are the things that we're going to be watching and looking for? And what are things that Pickett Research and Flock Freight are paying close attention to help us kind of understand the direction that we're moving in and how we can be preparing for that?
So I guess in terms of that whole supply and demand balance that drives the cycle to begin with. And so the first leg, and again, this cycle is typically 13 to 15 quarters long. This current one so far, at least, being no exception. It was 7 quarters up on during the inflationary leg, and then right now 7 to 8 quarters on the deflationary leg. So from a structure standpoint, it doesn't seem like a ton is that different versus past cycles. Obviously, context is everything, and contextually everything's different. So what's been happening over the course of this particular cycle? We've got pandemics, you've got war in Ukraine, you've got war in the Middle East, you've got a roller coaster ride with what global energy and diesel fuel kind of prices have done. But I think the supply side response during their inflationary leg, as far as I could tell, wasn't any different. And so look at things like net Class 8 tractor orders, and typically when you see spot and contract rates surge, you have asset-based motor carriers that have increased levels of operating income, regardless of who they are. They're usually yielding more profit because rates are higher relative to expenses, and expenses are going up too, no doubt. And so, when we're in that kind of environment, the most logical thing to do is to reinvest in the fleet. Mm-hmm. And even if you're not adding net new capacity, even if you're saying, I know there's a cycle, I'm not dumb, I've been through this before, but I am going to take this opportunity to reinvest in better fuel economy, better safety features, sure. Take the average age of my fleet from 5 years to 3 years, entirely rational sets of decisions. And so you do that and you put your truck orders in, and then new trucks show up. The challenge is your old trucks don't disappear, right? They go out to the secondary market, and that becomes the on-ramp, for the small, medium-sized carrier to come in. And if something like 90, 2% of FMCSA registered carriers have fewer than the 10 power units, I mean, that's kind of the swing that I believe is fundamentally driving the market, through these cycles of overshoot and collapse. And so even in the depths of an unforeseen, unprecedented pandemic, you still saw those truck orders happening at very high levels. And so from that measure, nothing really changed. What did change a little bit this time around was I think, earlier in the cycle, we saw those truck orders collapse. Typically the, year-over-year rate of net Class 8s correlates almost exactly with the spot line haul index. In this case, those truck orders collapsed probably 3 quarters early, most likely because the OEMs couldn't build the trucks fast enough, where you have, COVID supply chain disruptions, where, there was a time where the OEMs had to constrain or close the order books prematurely. And so you saw this, downdraft in orders. Wasn't because the demand wasn't there, it's because the supply, couldn't keep up. And so that distorted, at least the truck order side has made that particular indicator a little more suspect, this time around. And so you saw the same supply overshoot. There's no reason to believe that the same dynamic didn't happen. You saw it in operating authorities, this massive surge in operating authorities, starting in mid 2020, kind of all the way through kind of 2022, where it's very specifically, conditions are attractive, let's get into the trucking market. And you saw a wave of new folks coming in. Many of them were owner operators that decoupled from, large national fleets that were going out on their own. And so that happened. We saw the peak, and then, we've been in trough mode really for the last 6 quarters. We kind of went deflationary kind of Q2 of 2022. And it's basically there's this process where enough overcosted or uncompetitive supply has to exit, unfortunately, or demand has got to pick up. And from a shape of the deflationary leg of the cycle, this one's hasn't been that dissimilar than past cycles. We got our deflationary inflection point in Q1 of 2023 at minus 31%. And it's been a very slow grinding year-over-year journey back to equilibrium. And so just kind of mapping out shape of this cycle versus the last, consistent timing, suggest a forecast that, we could be, year-over-year inflation as early as this quarter. I mean, right now, by DAT, truckload spot index is sitting about minus 3% year-over-year, versus a forecast of plus 5. And so we're close, the equilibrium, zero being, right, the break point we're talking about. We're still grinding towards this inflationary market, but it's been super slow. And it's kind of been this, I think, this narrative of, 2 steps forward, 1 step back. I mean, the last one, go ahead.
Equilibrium being the truck capacity equals the shipper demand, basically.
Exactly. Yeah. So, or, year-over-year spot rates are 0, right? So Q1, Q2 line haul spot rates are the same as same period, last year.
So let's say we find this equilibrium. Someone explained this to me once, and it kind of stuck with me when I was early on in my journey trying to understand how things worked. Even if we're at equilibrium, nothing inherently changes if we stay equal, right? Then we're just in kind of like that holding pattern. So something has to then change further to cause rates to start to feel that pressure. We'll have the imbalance in the supply and demand. And so right now we have more demand than supply, or am I saying that backwards? More trucks right now than we have freight that needs to be moved. And so we need that to not just come to equilibrium, but then to inflect the opposite direction. So I think a lot of eyes now turn to what's going on in the macroeconomy, what's going on with consumer spending behavior, household debt, construction activity, government spending, I mean, you name it, manufacturing. A lot of people are looking to these types of things to predict when things might start to inflect in that opposite direction. And I think that's where I'm seeing the most disagreement maybe, or hypothesizing going on in what's happening. I actually just got an article the other day. I'm subscribed to a newsletter really for a conference, and they were talking about suppressed consumer spending has really been damaging freight volumes. And it kind of rubbed me a little bit the wrong way, because I was like, I don't think that's exactly what's happening. I think we've seen a lot of resilience, right, on the consumer spending side of things. So, but there's just a million different ways that things have been interpreted at this point. So what are your thoughts, and what would you contribute to that conversation on what can change this side of the equation? What are we looking for, and what macroeconomic factors are you guys watching?
So at one point to make around just that idea of equilibrium, it's almost like a fantasy state, where there's never been, at least I've observed, a period where we've had just static.
We never just hang out there, yeah.
We never just hang out at y equals 0, right? Because all these data points are changing in real time. You just don't know how fast they're changing. So it's almost like trying to get a sense of what the rate of change is with all those demand indicators relative to what's happening with the balance of seated Class 8, tractor supply. And so, from a demand standpoint, again, I think it's all about supply and demand. They're just very challenging to measure. There's many more demand side indicators that are out there, and the federal government does a great job, relatively speaking, of putting things out there, and different demand indexes that exist, and we'll talk about a couple of them. But you start to kind of peel back around. Ultimately, it's consumption that drives the U.S. economy, and so U.S. consumption has actually been holding up pretty well from a percent year-over-year change standpoint, and it's really goods consumption. So we'll look at, we just got the preliminary Q4 read on consumption. Then within that, durable and non-durable goods versus services. Durable and non-durable goods are actually, they bounced off their kind of post-COVID, correction, deflationary inflection point, have actually been fading, actually accelerating up into the right. Services consumption has been flat. And so this narrative around, a fundamental reallocation of goods spending to services, if it's in there, it's not obvious to me. So it seems that the consumer, at least as of Q4, right, these are all delayed, data points, is still buying stuff that's going to require, still consuming stuff that's going to require a truck to move it. And so consumption's still pointing up into the right, which is a bullish sign. Industrial production, however, hasn't followed suit. Typically, industrial production, the rate at which U.S. domestic, kind of the industrial plant makes stuff for domestic consumption, or for exports, as you'd expect, IP or industrial production tends to track consumption pretty closely, except in periods of recession, and there's a wide kind of divergence until things snap back. And so you've seen this period of a pretty constructive consumption patterns, but you haven't seen a snapback in industrial production. And so until you see that snapback in industrial production, it's hard to expect actual trucking capacity demand to snap back either. Right. And so industrial production's been flat for the last couple of quarters, despite a pretty constructive trajectory for consumption. The two primary demand indicators, that we look at, one is the cash shipments index, which tends to be, shipper sourced, mostly enterprise contract shippers. I think the January number just came out at, minus 9.5%. So still, clearly, deflationary. There's absolutely less volume demand out in the marketplace than there was a year ago. We'll also look at the ATA has got a volume index on trucking that's about minus 5%. So both of those are negative. They tend to track industrial production. But again, just based on the 25 years of kind of past history, either consumption is going to have to turn over, either consumption's not as strong as the numbers would lead us to believe, and that's going to have to turn over and converge back to industrial production, or industrial production just got to catch up. And so the indicators, at least the patterns I'm looking at, would suggest that the latter is going to happen. We'll see. But if there's a wild card out there, it's just kind of what condition is the U.S. consumer going to continue to be in over the course of 2024, and has that resiliency and that strength that's shown up in consumption numbers, kind of retail spending numbers, is that going to continue, or is there going to be some point where we all just get tapped out and you start to see a material degradation in some of these data points?
Well, I have a question building on that then, because I think that you say how the consumer is going to behave in 2024. And I think with an election year coming up, there's been a lot of conversation around, one, making sure we control inflation, but two, making sure we just keep things fairly comfortable, right? Nobody wants to go and make be the cause of, that the current party does not want to be the cause of that pain and suffering on these consumers going into an election cycle. So I think you mentioned this earlier too. You talked about diesel fuel. You talked about wars going on. I have to ask you too, I think wild cards right now could easily be an election year and then just geopolitical events that are going on right now. So how do it's obviously difficult to include those things in any type of forecasting, but how do we just kind of take things into account and kind of keep those in mind as we're modeling and making predictions?
So I guess all these topics are absolutely worth talking about, and be kind of, as these things come up, whether it's Houthis launching missiles in the Red Sea and steamship lines kind of bypassing and adding 2 weeks of transit time that wasn't there before. What impact is that going to have? Or potentially policy changes or regulatory decisions going into an election year. You got to kind of step back and say, okay, what does this impact? Is this a demand side kind of disruption or dislocation, or is this a supply side? Most of the election stuff and things like inflation, those tend to be kind of demand side, wild cards. And so the other things that we'll look at of just trying to model how resilient is the U.S. consumer. It's, we'll look at things like inflation adjusted wage growth and the rate of change of consumer debt. And so as we kind of peel back this onion and say, well, how do we think about the forecasted kind of direction of demand? Well, hey, what's industrial production doing? Well, how do we forecast that? Well, what's consumption doing? Well, how do we forecast consumption? What are the primary means of consumption? For average U.S. consumers, it's wage growth, right? Wage income, and then it's debt. For the most part.
Yes.
And if you look at those on a chart, inflation adjusted wages are on a pretty healthy trajectory, right? Inflation is absolutely coming down. Nominal wage growth is still there. Wages, look great, but not too hot. We want, a strong consumer, but not so driving in.
Everybody loves those to be a little better, right?
Exactly. And even, consumer household debt. I think the last, Fed print showed, increasing number of credit defaults, and I think credit card debt was above $1 trillion or kind of, whatever the number was. But on a percent change year over year perspective, those numbers are all coming down. They're not going higher, right? So the rate at which we're taking on debt is actually decelerating, right? So you have decelerating consumer debt, you have accelerating kind of wage growth. Paints for a pretty constructive picture of, at least at this point in time, how durable and kind of how resilient, how stable is the average household from a spending standpoint. And all those look pretty good. And so then you look at kind of things like, elections and what could an administration change between now and the end of the year. And, we'll go back through the last, I think, the last 3 or 4 elections. We've got kind of data on the last 4 elections. You had 3 Democrats, Republican, 1 incumbent party, 3 changes in the administration. And I'll kind of look at kind of where that happened relative to the freight cycle. And as far as I can know, there's no obvious impact either the year leading up or the year after that suggests that there was a policy change or anything fundamentally different that happened that kinked the cycle, or necessarily kinked the economy. Doesn't mean it can't happen, but I guess I wouldn't be looking too hard for kind of election disruptions to have a meaningful impact on when freight rates go inflationary or deflationary. It's only things like negating student loans or in terms of deferring those.
Sure.
Decisions that may get made after kind of the election. I think all those matter, but I don't put a lot of weight into them being at least market moving for the balance of 24.
Yeah, I'm going to take a lot of self-validation here from your answer, because this is kind of something that I found. And, I produce a monthly truckload market newsletter, which is a fraction as intensive as the work that you do. But I'll have people say this is so like economics heavy, like that's a lot to read. And every time I start trying to understand how might something impact the full truckload freight market, I end up talking about the labor market, the jobs data, like consumer spending, consumer health, debt, everything really kind of goes back to the strength of the U.S. economy, really, and what we see going on, because that's going to really impact, like you said, how susceptible are we to be impacted, I guess, by geopolitical events or changes or our own, government changing parties or anything like that. So I think that was a perfect answer to that question. And I also think it's worth noting that that's probably one of the reasons it's important to pay attention to macroeconomics as they fit into this space, because there's a lot of headlines out there that a lot of people, it can sound maybe more impactful than it really is when you're reading about, like you said, the Houthi military attacks in the Red Sea, and it's causing all this disruption. But then when you put that into perspective, especially if you're playing the domestic U.S. trucking market, does that really impact me and how much? And so it's good to have a better, I think, base to be grounded in for what's really going on and how likely events are to impact you.
And the geopolitical stuff, you got to think kind of what impact does this have on effectively U.S. manufacturers? From very, very early in kind of the pre-COVID, December of before everything kind of blew up in that kind of March and in April, where COVID initially was a sourcing components from Asia, supply chain issue, right? It wasn't on U.S. soil yet, but then you couldn't get components and subassemblies and materials out of Asia. The ports were closed, so it became this mad rush to find alternate suppliers. Everyone had sole sourced, put so many eggs in the Asia basket. Became a massive run on alternate suppliers, which created this kind of domino effect that compounded on everything else and drove massive supply chain disruptions. I think the analogy here with, or the comp to what we're seeing with the Middle East is, if that extended 2-week transits, is going to start to drive alternate sourcing decisions. But to say, okay, I'm going to start to find local sources, whether that's kind of bleeds into the nearshoring right conversation. Anytime you're changing right suppliers, materially changing your freight flows, that will have an impact on your transportation freight flows, right? So if the Middle East thing, bypass the Red Sea. Now all of a sudden we're going to, bring more imports into the West Coast ports as opposed to the Gulf and certainly the Panama Canal is part of that conversation. Do you not have contract freight lanes inland from that port? You probably don't if they're unplanned, freight flows. And so as these disruptions happen, it's not any different than kind of Christmas tree season or produce seasons or hurricanes or even unplanned, even a planned surge in either demand or a kink in supply. And all of a sudden you're having to go resource freight lanes that were contracted because they were planned and now they're spot because they weren't. That can also, drive kind of material changes, from a cost standpoint and could be a tailwind for what happens with spot rates.
Absolutely. Okay, I have to pause for a second. We have had a very quiet audience today. I can see these people watching, but nobody asking questions yet. So I'm going to ask for questions. If anybody does have any questions for Chris before we wrap up, we'd love to answer those on the show. If you listen back to this later and you didn't have a chance to ask it live, go ahead and drop your question in the comments. We'll start and get to that one. And then I do want to take a second too to thank my podcast sponsor, TIE Software. We were just at Manifest, the Future of Logistics in Las Vegas, which was amazing. And I was reminded of their focus right now on collaboration. And so they are really focusing on making sure that brokers have all the tools that they need in that TMS to operate efficiently and to be technology focused. So that was a great reminder for me. And as a former TIE software user, I can't recommend that enough. And the advancements that they're working on right now are very exciting. So, Chris, as we are wrapping this up, I have one more question for you. I think what I would love to know is if you were sitting down right now or talking to a room of, let's say, owners or executives or leaders in the brokerage or even asset carrier space, what would be some of the advice that you would give or maybe suggestions that you would give to them if they are saying, we are trying to better understand the market and our position in this market and how to make sure we're making smart decisions, understanding the macro economy, and what are just some things that they can start to do to be more in the know and involved in what's going on and make sure that they're taking the right strategic position within the space?
And so let me lead that with the actual forecast in terms of where Pickett Research is still projecting the market to fade through 2024. I think at the last call, I think I made the point, hey, we're expecting an inflationary spot market as early as Q1 and then rates to storm 30 to 40% higher. That's still the base forecast. I think we may take an extra quarter to break inflationary, but current trajectory, past patterns suggest 2024 will absolutely be an inflationary spot market. Breaking as early as this quarter, but for sure by second quarter, and still projected, again, if this cycle is anything like the last five, to run up to 30 to 40% higher, right, by the end of 2024. Okay. That's contract rates are going to follow as they often do, where we don't expect contract rates to break inflationary until the back half of 24. And so year forecasts like that, as a starting point, it's really just looking to understand kind of how that relates to your business. And again, I would say the same thing if it's a room full of procurement professionals, or shippers trying to figure out freight budgets or positioning, where I think at the end of the day, you want to basically build as much flexibility and optionality across your platform such that you can identify changes in trend as they're happening and then adapt quickly. So to do that, you need to understand what's happening to you. And that may mean investments in tech. That may mean, investing in talent just to do the work and understand kind of what is your, average, spot versus contract, line haul rate. How is your fleet positioned in terms of how much of your fleet runs, on a contract rate? How durable are those contracts? How active are you in the spot market? Is there a dedicated, segment or strategy there? And then I think then you just want to have an opinion. I mean, you want to take in as many sources of information. Pickett Research is one, www.pickettresearch.com, but there are other fantastic ones out there. I think a great evolution of the last 2 years is just how much data there is. And so the one, fantastic, there's tons of data, but the downside, oh my God, there's tons of data. Right. How do I know what
do we do with it?
Attention to. But I think you got to do the research, and I think you have to invest in, in the talent, or find the kind of the partners to, figure out the 5 or 6 or 10 data points. I think that's part of, the journey with, my own discovery of how these markets work is there's a billion different things you can look at. I probably look at 15. And it tends to be the same 15 indicators that have historically been, more prescient, right, than others. And sometimes new things will come along, and I'll try to correlate those to see if there's anything there, and then usually we'll end up tossing them. But I don't think there's any shortcuts. I think the worst thing you can do is really not have an opinion, and in that case, you're kind of left with whatever the next whoever's got the loudest voice, and there's so much, again, often contradictory kind of direction and advice based on who's giving these forecasts that whether you're right or you're wrong, at least you have an opinion. And to have an opinion, you've got to do some research and you've got to do a little bit of work.
Yeah. We did just have a question, so we'll go ahead and take this. And they said, have you noticed any change in the behavior of shippers, specifically post-COVID, that would help explain the continued delta between contract and spot for van rates? Thinking of that question, I think I can kind of see what they're saying and maybe have an answer of my own. But what do you think? How did the shippers react basically to coming back into what a lot of people call, a shippers market here the last couple of years?
I think you're seeing contract terms stretch out when things like spiked, right? Nobody wanted to lock in kind of at the top end of the market. So you saw, and again, tech evolved to support this. Gone were the days of the 1 to 2 year bid term. And there's still plenty of shippers that buy that way, but you started to see bid terms kind of compress, and it became okay. Let's just do a half year. Then became okay. Let's do for a quarter, and then you end up kind of rolling those over. As we get into the trough years, the trough quarters, you get a reversal of that where now everyone's trying to time the bottom of the market, and all of a sudden those quarterly bids turn into 1 year commitments.
Yeah.
But again, a lot of what's happening on the contract side, contract rates are still going down. I've got a spot forecast that looks up and to the right, but contract is still deflation. Anyone who's out in the market right now in a procurement event is probably seeing your contract rates go down because there's so much compound pessimism. And it's not like the shippers are pushing them down. Like the supply side is doing it. The supply side is going to say, I'm going to bid whatever I need to bid because I don't know what the future holds.
Right.
Just for the right to turn this freight back if and when the market does shift. So anything, I don't know if the shippers' behavior has really changed outside of trying to get back to this kind of ideal of normalcy, and they're really trying to stretch out bid terms and trying to lock in to the extent that's ever even possible suppliers towards longer terms.
Yeah, I love that. I find myself often playing devil's advocate when we're talking about shippers. I know a lot of shippers. I have had great relationships with them. And when I hear people ask, why are the shippers doing this? And I'm like, well, because they have those options available to them. And so there are, like you said, on the supply side, people are presenting them with these rates. And so what are they supposed to do? Say, no, I'm not going to try to save money this year, because they have ample options to do that. And oftentimes it is also with partners that they know, like, and trust. So I would agree with you there. I think this will be an interesting year for sure, because I do think that overall we saw continued rate pressure at the end of the year and the beginning of this year on contracts, or at least I think we maintained or decreased some there in that space. And then if we do see a 30 to 40% inflection in spot rates this year, I think it'll make things get pretty interesting, especially for brokers in the latter half of this year.
Yeah, I think the more enlightened shippers that are out there, you have used this time to be a little more thoughtful on strategy. Where it's, again, I wouldn't say that shippers are it's a race to the bottom and
Sure.
forcing carriers in a business. I don't see that happening. But I do see them more thoughtful around trying to shrink the ranks of kind of what you would call strategic capacity partners, trying to think about what is the role of non-asset versus asset-based capacity in an up market. So at least go through that scenario planning of, if we do get some verge of inflation, is this a transportation strategy that's likely to hold up? I've already done the homework around, okay, what freight could actually move over the rail? What is the role for shared truckload in this kind of a market environment, given my freight? How do I think about LTL? And so you do that homework on the front end, and then you've got that playbook in hand where you're ready regardless of what the market brings you.
Okay, so if a shipper or a carrier is interested in learning more about Flock Freight and partnering with Flock to help insulate them and give them some more strategic options for the changes that are going to happen in the next year, how would they best contact you? If someone is interested in Pickett Research and understanding the work that you do there, how would they best contact you? And if anyone has questions for you, Chris, how can they best contact you?
So there's plenty of stuff at flockfreight.com, plenty of stuff at picketresearch.com. I think, to make it easy, if there's anything in here that warrants follow-up on either front, you just email me at Chris, CHRIS, at flockfreight.com, or you can find me on LinkedIn.
Awesome. Well, Chris, thank you so much for coming on the show today. I really appreciate it. Enjoyed meeting you for coffee. And thank you so much to all of our guests as well for meeting us for coffee.
Enjoy Florida.
Thank you.
Thanks, Samantha.